Hey guys, I'm Phil Town from Rule 1 Investing, and today we're going to be talking about the 5 worst investing mistakes that I'm seeing investors make right now in 2025, particularly with this recent stock market turbulence, all this volatility. It can be a little bit of a tricky time to invest, so let's talk about some common traps that people fall into in these periods and how you can work around these problems to give yourself the best possible chance at having really great returns, and that's what we're all about. So first things first, you guys, we need some context. So what's the investing environment that we're seeing today? Which is really interesting. We have had incredible returns going on for the last few years. In 2023, the Dow went up almost 14%. In 2024, the Dow went up almost 13%. The S&P 500, which is ballooned up with the Magnificent Seven, the Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla, those guys just exploded. And without those companies, it would have been about the same as the Dow. But with them, the S&P was 24% in 2023 and 23% in 2024. So extraordinary, stunning, historically high returns. And speculation has been running rampant. We've seen it in crypto, in the Mag 7, just off the chart how that's done. And the market's still running hot. And now in the space of a few months, all that sentiment that's been going on for years that it's just always going to go up has started to get into a bit of a flux state. Greed is still there, but fear is starting to creep in a little bit. So this can be a really confusing time to invest for a lot of people, and it can be punishing, man, if you go in with the wrong mindset. So with that in mind, let's kind of go through 5 common investing mistakes that beginners often make before they get educated in how to do Rule 1 investing and why those mistakes really weigh in on your returns. So the first one is something that actually even professionals have an issue with, and that's hubris. It's basically, I can do no wrong. I am a god of investing. It's usually we don't feel like that, but you do have hubris when you start to have a bad case of overconfidence. And strangely, it frequently plagues new investors. You would think it wouldn't, but no. New investors that are getting into the market during bull runs. And basically what they're seeing is that everything they do turns out to work out. And it can really knock down your returns when the market turns down. The truth is that many new investors are going to mistake their success as a result of their own skill rather than recognizing it primarily driven by just broad market momentum. So hubris kind of is a bias that manifests itself in 3 ways. First way is you get overconfident, and that's kind of the belief that your abilities or your performance is greater than they actually are. Second, it's going to be over precision, and that is you have a tendency to think you can really dial in that growth rate or really dial in, right? Your predictions are very, very accurate on a company's value, perhaps. And finally, confirmation bias, which is just an absolute nightmare that we all face. Confirmation bias is a tendency for individuals to just turn a blind eye to negative information that's coming in because they're so deeply biased at their own decisions. So even experienced investors get caught by hubris and confirmation bias. I've made some of my biggest errors when I thought I really understood a business and I didn't. And it's just why we press so hard on this idea that you want to stay within your circle of competence that Buffett talks about. You get outside that circle or get on the edge of it, you're there because of hubris. You think you know more than you do. Now, the second thing is people really get rocked is fear of missing out, getting FOMO. The fear of missing out is a psychological concept. It plagues everybody, believe me. You know that feeling when you're sort of out of town and you hear all your friends are getting together for a big party. That's FOMO. The fear plagues investors as well, and it plagues us particularly in markets that are rising really quickly. You might hear your friend is making money on Bitcoin. You might hear they bought a penny stock that doubled, or you see a commentary on CNBC that's telling you, bad time to be out of the market, stick with it. On the flip side, you might see a stock's down 15% in a few days and then rush in and buy it because it's clearly on sale, just because it's fallen down in price. Sudden stock price drops frequently lead investors to just completely disregard valuation and buy businesses without doing their due diligence, without doing the work that you need to do to make sure you understand the business and that you understand the value. Just because it went down doesn't mean it's on sale. And when you don't know that, it increases your risk of loss. Yahoo, for example, toward the end of 1999, and Yahoo's something most of you guys might not even know about, but it was a big deal in the internet revolution that was going on in the late 90s. And in 1999, Yahoo investors bid the stock price up to a point where it had a PE ratio of 11,000. It was priced so high that Yahoo needed to have the revenue to be almost the same size as the entire US gross domestic product. In other words, basically everybody in America had to buy, with all of their money, just Yahoo, nothing else. No food, no cars, no nothing. And still, stock buyers were flooding in because they just couldn't miss out on those returns. The price got bid so high over anything reasonable of intrinsic value that even when their earnings came out and just, were super high growth rate, the stock started to fall in 1999. It was like even the highest growth rates couldn't make sense out of the price people were paying for this thing. And it's like if a thing goes too high, it will fall. And the market crashed and brought Yahoo down with it. Ultimately, it became less than zero value and got turned over to Verizon, which owns what's left of it. The big takeaway here is fear of missing out, FOMO, can often suck guys into situations that they just don't fully understand, and it greatly increases your risk of losses. All right, next one. Thinking the current market trend will never end. Oh man, this has got so many people hooked right now. There's a known recency bias, right? Where people believe the recent trend is going to continue. That's why casinos love to show all the hot numbers on screens. And the reality is the probability of any given number doesn't change, but that tactic helps tap into a gambler's recency bias. It increases the chances that they'll make stupid betting decisions, which the casino loves. In the stock market, recency bias causes investors to believe that because stocks have been rising, they will keep rising in a bull market and they'll just always go up. And when stocks fall, that recency bias kicks in, amazingly, and pretty soon people think stocks will never come back. They'll continue to fall further. Now, why is this dangerous for an investor? Because it's a bias that makes people buy expensive stocks instead of selling them. And when they sell great companies after they've gone on sale, instead of buying them. So to get it completely backwards. So the reality is markets always go through cycles, you guys. And individual companies are always going to revert to where they will be finally priced at what they ought to be priced at. Price and value eventually will come together in the market. Companies that are hideously overpriced today are going to correct given enough time. And in the same vein, businesses that have had their share of being priced unfairly are going to recover. So there's a very famous saying, in the short term, the market is a voting machine. It's just all emotion by voting. In the long run, it's a weighing machine. No emotion in it, price and value are going to come together. So thinking that a bear market will never end is one of the mistakes that leads new investors to eternally stay out of the market. People didn't go back into the stock market for decades after the Great Depression, thinking that it was a terrible idea to invest in stocks. And vice versa, thinking a bull market will never end, eternally traps investors into sticking with vastly overvalued businesses at precisely the wrong time. And am I making my point here? That's what's going on right now. Now, the next thing is overusing leverage in options trading. This is where the gamblers get rocking. Markets have been rising quickly, and it encourages a lot of short-term gambling, especially when there's a lot of volatility like there is right now. And that results in a lot of investors turning to leverage and options trading to try to crank up their returns. And this is a result of the biases we've already discussed. When investors feel a bull run's going to last forever, they're overconfident in their own abilities, and then they're much more likely to use really high-risk strategies that they don't fully understand. And sure, it could work out in the short run. I mean, take a look at GameStop and Reddit. Maybe you get lucky, but when it doesn't, getting caught out with a big options bet or being massively over-leveraged is really a one-way ticket to bankruptcy, as many have learned over the last few months. And both of those situations where you're unnecessarily increasing downside risk, you really, really want to come back to what long-term investing is all about. We want situations where it's heads I win and tails I don't lose much, And that comes from our friend Manesh Prabhai. We don't want heads I win, tails I lose everything. That's not what you want, you guys. So there is a right way to do options, by the way. Warren Buffett is one of the biggest options traders in the world. And here's a clue. You might want to be the casino and not the gambler. More on that some other time. Now, lastly, straying beyond your circle of competence is a surefire way to get completely hammered financially. One of the biggest traps of the big bull and bear markets is they somehow make investors meddle around in things that they don't know anything about. And this comes back to the fear of missing out problem. Investors see stocks like Nvidia rising straight to the rocket ship to the moon, or alternatively, they see GameStop dropping 50%. And they just can't keep their hands off this stuff. In these situations, they sort of feel compelled to just go buy due to what's happening to the stock. It's going up, it's going down, even though they don't know anything about it, right? So drifting outside your circle of competence, this is another one of those actions that really raises your risk of losses. And worst of all, it means you're going to be totally clueless when the market goes the other way. If the market falls, whoa, did this great deal that I just wanted to do, did that just get better? Is there some fundamental problem with the company? It's going to be completely bankrupt, right? And if the stock is going up, okay, should I lock in profits now and sell it? Or is this really just the beginning of this gigantic franchise that's going to make me rich? And you don't know because you don't understand the business in the first place. You just don't understand the business. So how do you get around all of these issues as a new investor? So I got a strategy for you. If you have a robust strategy, that is strategy and tactics that you follow in all market conditions, then you're going to be a lot less likely to fall into these kinds of traps, you guys. The strategy itself is going to stop you from doing anything stupid or rash. And that's what we're all about at rule number 1. We look at the meaning of a business, the mode of the business, the management, the margin of safety. There's a handful of numbers, the big 5 that we look at. We are absolutely following Warren Buffett's principles that have worked for ever since Ben Graham developed them all the way back in the 1930s. And that keeps us on the right track, no matter what Mr. Market is busy yelling at us over the fence. So, with that said, thanks for watching this thing. And let me know in the comments, what's the worst investing mistake you've ever made? I don't know if I'll tell you mine or not. Also, before I sign off, I do want to let you guys know that if you feel like you're ready to kind of take that next step in learning and want to come and understand rule number 1 strategy from me and my team, we'd love to see you at the next workshop. We've taught over 25,000 people just like you how to do this. The workshops are 3 days long. They're really, really fun, all live, and they're hosted entirely online. We go through everything you need to know to become a Rule 1 investor like Warren and Charlie and me and Manesh and Guy Spear and all these guys. So please check out the links in the description and pinned comment to learn more. And that's it for this video. Now go play.